you, Amy, and welcome everyone to our mid-year economic and market update. The last time that we were together was actually last November, just following the elections, and we had Jeffrey Kleintop from Charles Schwab joining us. Of course, there was a lot to talk about at that time coming off of the election and really the uncertainty as we moved forward with regard to COVID, the economy, and the markets. But if we fast forward to today, looking back, the markets certainly have been very strong. The economy is very strong. Earnings, we're in the middle of earnings season and earnings are very strong. But in the midst of that, there's still a lot of questions out there and some uncertainty. Questions around COVID and what impact that might have on the markets going forward. Tax reform, we'll be hearing much more about that in the days and weeks to come. And probably new to this year has been the emergence of discussions around interest rates and inflation. And those are weighing heavy right now as we look forward into the markets as well. So where do we go from here? We're going to talk about that today. And we have joining us today, Dr. John McDermott, who is the Chief Investment Strategist at Symmetry Partners, located in Glastonbury, Connecticut. He's also a professor of finance at Fairfield University. And Dr. McDermott is really well known in the academic world, has been very well published, and we're fortunate to have him here with us today. I've known Dr. McDermott for a number of years now as we serve jointly on our investment committees. We meet every quarter, and pre-COVID, I got to travel to Connecticut on a quarterly basis to have our investment committee meetings, and have had many dinners with Dr. McDermott talking about the markets and the economy, and I've always enjoyed those conversations. Dr. McDermott's also been a part of the engineering of the Eide Bailly investment portfolios that we call sleeves that now have close to a 6-year track record. We continue to work jointly together, looking ahead and developing new strategies that we'll be launching later this fall. And as Amy mentioned, as we go through today's session, please feel free to ask questions on the Q&A button. I'll look at those questions as they come in, and we'll either address some of those throughout the session today, or reserve those towards the end of our session today and address them at that time. So thanks again for joining us today, and we look forward to the discussion. With that, Dr. McDermott, I'll turn it over to you.
Thank you, Brad, and thank you, Amy. I'd like to reiterate what a great working relationship Symmetry and Eide Bailly have together. It's a long-standing relationship now. We work together on creating investment solutions for Eide Bailly clients, and I think we do a very good job at it. I'd like to take the opportunity at the beginning of the presentation today, before we get into the market update, to talk a little bit about how Symmetry and Eide Bailly view portfolio construction and view how a portfolio's expected return is determined. And that will provide a little bit of background for moving forward into the economic update. So with that as an intro, I'm going to share my screen and begin the presentation. I'd like to thank Brad for this opportunity as well to speak to the good people at Eide and talk to you about the markets. I do appreciate the opportunity to do that. So at Symmetry and Eide Bailly, we practice something called evidence-based investing, or you could also refer to it as factor investing. And the evidence-based part comes from the idea that we look to academic research for guidance in determining investment philosophy and investment objectives and investment strategy. Dating back to 76 and Adam Smith and the wealth, and coming all the way forward with Andrew, who's the head of factor investing at BlackRock, Cliff Asness, who's the founding principal at AQR Capital, Ken French, who's board of directors at Dimensional Fund Advisors, another one of our investment partners, as well as Gene Fama, who's a Nobel Prize winning laureate from the University of Chicago, where his work on efficient markets also works for Dimensional Funds. So we look to academics for guidance on what should work, if things are working in an academic sense in the investment world. And we also look for rationales, not just going in and doing studies based on data, but also if there's an economic rationale to back up something in the investment world, say, for example, the market risk premium or duration risk, should that be associated with higher returns. So when I say factor or factor investing, there's actually a couple of different ways to think about factors. The factors that we're speaking to are referred to as style factors. And I'll make a contrast to other factors that you may hear of, which would be more of macroeconomic factors. So one way to think about trying to explain the stock market and the performance of the market and different asset classes is to look at things like GDP and interest rates and productivity and inflation and the slope of the yield curve. And those macroeconomic factors can give you some basis for forecasting stock market performance. It actually doesn't do a great job of it before the fact, ex ante, but ex post, it doesn't do a bad job when you're looking backwards. Style factors are different. Style factors are things like value, size, momentum, profitability, quality, minimum volatility. They help us understand why securities or sets of securities may have different expected returns than others. So when we think about a factor in that term, and I'm going to stick with style factors, you could think about it as a source of returns or a source of premiums or higher returns. So in finance, when I speak to my students, I'll always ask, if you have two assets and you're looking at them, or two companies, why would you expect one to have a higher return than the other? And the typical answer on that, if I'm doing a good job explaining things to my students, is risk, right? There's a risk-return relationship in finance. Higher risk should be associated with higher expected return. But there's also another explanation, and that's behavioral. If investors are shunning a particular asset class and depressing their price, they would expect to have higher returns going forward as compared to an asset class or stocks that are being bid up in price. They would have lower expected returns. So these differential returns can be explained by risk-return relationships and also by behavioral considerations. So factors, if a factor works or a factor helps explain differences in returns, it could be because of the factor represents a source of risk. It could also be because the factor represents some behavioral phenomenon that's going on, or most likely it could represent a combination of the two. So I'll start with the simplest example of a factor, and that's the equity risk premium. The return on equities in excess of the risk-free return that we expect going forward. Now I say expect because we know that the equity risk premium is highly volatile, and in some years it could be quite negative, the realized premium. In some years it could be very good, but on average in the history of the United States, the equity risk premium is somewhere around 6%. Has been realized. Oh, okay, great. Sorry about the technology problem. So the market risk premium is somewhat evident. The source of the additional return is risk. Equities are riskier than treasury bills in every sense of the word, and investors expect a premium for investing in equities relative to treasuries. So that gives rise to the premium, and it's based in risk. That's the simplest factor. There are other well-known factors that come out of academics. I'm going to go through them on the next slide. The size factor is one, momentum factor is another, profitability and quality is a third. So let me just spend a moment going through some of the factors that at Symmetry and in the Seasons portfolios at Eide Bailly that we look to to structure investment solutions around these factors. So the first is self-explanatory, the market factor. We do have the second factor is the value factor. And the opposite of value, or the other side of value, is growth. So the idea with the value factor is that less expensive securities tend to outperform more expensive securities, or value securities tend to outperform growth securities. And that, in the history of the United States, has been about 2% a year. One way of measuring value, and there's lots of ways of measuring value, is the price to book ratio, price to earnings ratio, price to sales. Basically, any measure of price divided by a fundamental. If that price is low relative to the fundamental, it's a value. And if the price is high relative to a fundamental, like sales or earnings, it's growth. So systematically investing in value securities in the United States over the history of the US market has provided a premium of about 2% per year. Other equity factors that we tend to target are small cap. So small cap securities tend to outperform large cap. Higher quality companies tend to outperform lower quality companies. And a subset of quality is profitability. Certainly a momentum factor, which is behavioral, and that's stocks that have recently performed well, continue to perform well relative to stocks that have underperformed recently. And then there's a factor based on low volatility, which is somewhat counterintuitive. And that's that the very highest volatile stocks, when you sort stocks in the United States, tend to be abysmal performers. So if you're structuring a portfolio, you want to try to excise those very, very highest volatility stocks, which normally turn out to be small stocks that have low profitability, and you can improve your risk-adjusted return. So sometimes it's known as min vol, sometimes it's known as low vol. So those are the securities that those are the factors that we target in the equity portfolio. And here you can see them rolling out one by one. And we also look at factors in the fixed income, which is a lot less complicated, but in the fixed income factors, you've got interest rate, which is longer term fixed income securities tend to outperform shorter term. So one way to increase the expected return of a portfolio is to increase duration or maturity. And the other is credit. Securities that are a higher credit risk tend to outperform securities that are a lower credit risk. And that factor is about 1% in the United States. There are other factors in fixed income. Basically, any characteristic that is less favorable in terms of reinvestment, liquidity, duration, call and extension characteristics as compared to securities with the more favorable characteristics, respectively, you would expect to get a premium for that. So for example, if there were two bonds side by side, identical in all respects, except that one was less liquid and one was more liquid, if they had the same expected return, no one would want to hold the less liquid bond. So the way that the market would clear is that the expected return on the less desirable bond, the less liquid bond, would have to rise. And the way that the security's expected return rises is the price is depressed, right? So once you get a differential price, you get a differential expected return. So that's the way we view investing. And it can be sized in a nice chart, very simple, in that if I'm into beta returns, that's the return you get for investing in the market, as compared to returns that you get from active management and technical analysis. The factors can explain a lot of what was traditionally or conventionally known as alpha. And it's not to say we don't believe that alpha doesn't exist, just that it's very difficult to find, and that many times when you think you're looking at alpha, what you're actually looking at is returns to factors. So with that as an introduction, let me begin with looking at factor and market performance in 2021. Just to take since Brad mentioned at the top, if we take a look at what happened in world equity markets in 2020, it actually was a very good year in 2020. The return to equity worldwide was approaching 17%. In the United States, it was around 21%, which was the leading geographic area. And developed markets outside the United States trailed the US significantly with an 8% return, and emerging markets only trailed the United States by a little bit. So this is kind of ancient history at this point, but you could see the significant downdraft in March of 2020 due to the onset of the COVID crisis, and then kind of a nice march upward through the end of 2020. Brad mentioned things progressed in 2021. And this is data through the end of June in 2021. World equity markets have continued to do well, 13%, just shy of 13% as of the end of June. The United States continues to lead the way with a return of almost 15%, and emerging and developed markets are lagging the United States. So we've got this recovery post-COVID extending into equity markets from March of 2020, just about through today. As Brad and I were talking at the beginning of the presentation, equity markets are up again today, if only slightly, but continuing their drive forward. Now, in terms of factor performance in 2020, what I've got in this slide are long-only indices from MSCI in the United States that provide you with the factor returns on the long side for different strategies. So the USA equity market was up 21% according to the MSCI index. If you had invested in stocks that have recently done well, that's the positive momentum strategy, your return would have been almost 30%. So it was a very positive year for momentum and investors who are using momentum-based strategies. In terms of small cap tended to lag the equity markets by about 2%. So it wasn't a great year for small caps, but it wasn't a terrible year for small caps. Quality securities and high profitable securities beat the US market slightly by about 150 basis points. But you'll see down here, the most negative performance from a value standpoint in 2020 was the performance of value and value securities. So a long-only value strategy earned only 1% in the United States in 2020 when the market was up 21%. So value trailed the market by 20%, which means it trailed growth by about 40%. So it was just you could call it a value crash. Value just had a horrific 2020, and investors who are oriented to value or overweighting value securities certainly experienced underperformance relative to the broad market. Now you could see that if you were a multi-factor investor, which Eide Bailly and Symmetry are, and you were diversifying your factor exposure across momentum, value, quality, and small cap, that you would not be underperforming as poorly as if you were just a straight value strategy. So how have factors done so far in 2021? Well, most value investors like myself, were really hoping for a big turnaround as coming out of 2020. And at the beginning of 2021, we were pleased to see that value was doing quite well relative to the broad market. So you could see that in 2021, value was up 17%, while the broad market was up 15%. The difference through the end of the first quarter was actually about twice as large as that. So value has come in a little bit since the end of the first quarter, but still showing a nice hefty about 3% overperformance. And you could see that minimum volatility and to a lesser extent momentum, to a greater extent momentum, are underperforming the broad market index. So what's going on with value and growth? That's going to be the next part of this presentation. So we've seen that in world markets, the US has continued to kind of lead the world in terms of equity return. Europe, Asia, and the Far East, Europe, Australia, and the Far East. And, but within the United States, we've had this real outperformance of growth in 2020, which has kind of come in a little bit. It's been a little less pronounced in 2021. So I'm going to spend a few minutes kind of talking about that. Tech stocks in particular, and the US market in general, we'll see have extreme valuations presently. These are the PE ratios of some well-known tech stocks as of the end of last week. And you can see for SPY, which is the S&P 500, the average PE is 30. So for historical purposes, the average PE of the S&P 500 is usually somewhere in around the area of 15. So valuations you can think about as being twice as rich as historical. Then you can see that some of these tech stocks, notably Tesla and Amazon, have extreme valuations, even relative to the S&P 500. The other kind of risky aspect of this is that these firms are very large and have an outsized impact on index performance. So for example, in the United States, Apple, Microsoft, and Amazon are about 13% of the US stock market and 16% of the market cap of the S&P 500. And then if we extend that out to the 10 largest stocks, the 10 largest stocks account for 23% of the US market and almost 30% of the S&P 500. So these large stocks that are performing well and creating outsized returns and into effect driving the US stock market, it turns out that this is not a chart. I would ask you to kind of look through it later if you get the chance, but it's a summary of some research by Hendrik Bessembinder, who's a renowned academic, and he just recently published a paper called Do Stocks Outperform Treasury Bills? And what he found was in the history of the US stock market that about 4% of stocks provide the entire market risk premium. And then he's got in this chart, the top 20 wealth creators in the United States plotted against the years that they've been publicly traded. So these stocks, these small number of stocks are driving a tremendous amount or percentage of the increase in the US stock market. So when you parse this down a little bit further, probably his most, I think, interesting finding is that about 4% of US stocks over the history of the US stock market, which is about 1,000 stocks, account for the entire market risk premium, right? The entire performance of the market above treasury bills. Put that another way is 96% of stocks in aggregate only provided the rate of T-bills. So what do we take from this? The current situation with the big gainers being in tech companies, and this historical research that shows that wealth creation is really concentrated. The statistical concept there is that returns to stocks are highly skewed, positively skewed, is that when we invest, we should be really careful to not have concentrated positions in stocks, to diversify across as many stocks as possible, because you don't know which stocks are going to be the ones that are going to be these prime drivers of wealth creation. And that is a important tenet of our investing philosophy at Symmetry and Eide Bailly, is that we want to provide diversification across a lot of stocks, and that we avoid the temptation to kind of market pick or to drag onto stocks that have just recently done well without regard to any other considerations. So the current market, I mentioned that the S&P 500 had a PE of about 30. Well, this is PE for entire US equities, currently stands at 34.4. And this graph shows you the history of what is known as the Shiller CAPE PE, which is cyclically adjusted price earnings ratio in the US, dating back to 1900 through the present. And you could see that not since 2000 have we had PE ratios that were at this level. And if you recall, in early 2000, it was the height of the tech bubble in March of 2000, actually. And then we had the tech crash and the PE ratios coming in. And then again, we have here around 2009, the great financial crisis, another big drawdown in valuations. And then we've had kind of a steady march up through the pandemic to where our current situation is. So historically, as I said earlier, the stock market is very expensive when using a metric like a price earnings ratio or any ratio. You could do sales, price to sales ratios as well, or price to revenue ratios, and you'd come to basically the same conclusion. Currently, stocks are expensive, but also growth stocks are historically expensive, which another way of saying that is value stocks are historically cheap. So what I have in this chart, it's a little busy. On the y-axis, I have the number of standard deviations away from the mean that the value spread is, and I'll explain the value spread in a moment. And then across the x-axis, we have time. So the value spread, which is measured on the y-axis, you can see is at an all-time high for US large cap, international, and emerging stocks, right? That's where we are here. So what is this value spread capturing? So if we think about the PE ratio of growth stocks as compared to the PE ratio of value stocks, that currently growth stocks have the highest relative PE to value stocks than they've almost ever had in the United States and in international markets and in emerging markets. So as of the end of December 2020, we're at the 95th percentile for the size of the value spread, or you could think about the cheapness of value. And in emerging markets, we're at the 100%. It's an unprecedented level of cheapness of value stocks. The other side of cheapness of value is expensive in growth, right? So you can also say that growth stocks are at an all-time high in terms of their price per fundamental, in this case, earnings. So what does this mean?
Dr. McDermott,
Yes.
Quick question. So
Sure.
as you talk about the various factors and ways to diversify across the factors, we had a question that comes in, that has come in. Are ETFs a good strategy or a good vehicle to utilize to try to diversify across factors?
Yes, absolutely. That's a great question. I think the obvious answer is depends on the ETF, right? So if the ETF is designed to capture a factor, so let's say, for example, the MSCI ETF MTUM, which is the momentum factor. When you look into the methodology of building that ETF, it is very much a play to capture momentum as defined in the academic literature, right? So as a result, that ETF shows up as a holding in the season's portfolios that have an emphasis on U.S. equities and factor exposure. So not all ETFs, certainly, but there are that are very good at providing diversified exposure to the different academic factors across the globe, whether it's US, international, or emerging. And in the seasons portfolio, we make very good use of those ETFs because they're very efficient from a tax perspective, and they're also very cheap. You have anything to add to that, Brad?
No, nothing to add. Thank you.
Thanks. That's a nice question. In the seasons portfolio, we have a mixture of ETFs and mutual funds. Our stated preference is to be in ETFs because of their tax advantage and also because of their low expense ratios. And also it's become cheaper to trade ETFs on the platforms that we're on, where it used to have ticket charges associated with it. You could essentially trade them for free now. So where there's an ETF, we'd rather an ETF as compared to a mutual fund. There are certain exposures that you can only get in a mutual fund wrapper, and then we'll be using a mutual fund instead until an ETF comes around. So the current environment, what does that high PE ratio mean that we're experiencing? You saw that we're at a kind of a historical priciness of the U.S. equity market in terms of the Shiller CAPE PE ratio. So this is a historical look back, and I'll explain this chart. What we do is we sort PEs of markets in the US between their lowest level and their highest level, and we put them into deciles, right? So you can do that for each month. So decile number 1, you can consider that the cheapest market, where the PEs were of the US market was somewhere between 5 and 10. And then all the way on the other end, which is where that represents the most expensive market, somewhere between 27 and 46. And you saw we were around 35. So most definitely in the 10th decile of starting PE ratios. And then you look at the average 10-year return following that PE regime. And then we also look at what was the worst 10-year return and what was the best 10-year return. So what you see from this chart is that when markets are cheap, the average return in deciles 1, 2, and 3 is actually quite high. And the best realized returns are really robust. And even the worst realized returns aren't too bad. But when you're in this very rich regime like we are now, the average realized return over the following 10-year period is really very modest. Right now, these are real returns, so they're in excess of inflation. They're not nominal returns; they're real returns, so in excess of inflation. So you could think of this as somewhere around 4 or 5%, right? And then you can see that even in the best case, the real return is less than half of the other best 10-year realized returns, and sometimes as much as a third of those best realized returns. So historically, the lesson here is that very pricey market, high PE ratios, putting yourself in the 10th decile, is we need to moderate our expectations for returns going forward.
Dr.
Another way of
McDermott,
looking at this is to look at some.
Dr.
Yes.
McDermott, just a quick question on that. Is it possible that high PEs and forecasted inflation, there's a correlation there, since this is a real rate of return chart?
high PEs and inflation.
Yeah.
There could be, except when you think about PE ratios, right? So it's a nominal price, which includes inflation, and it's a nominal earnings, which include inflation. So when you divide P by E, the inflation gets canceled out, right? So PEs are in effect real, right? Because inflation it also impacts the denominator. But it's an interesting thought. I'd actually have to think about it a little bit more to see if I have a better answer for that, and I'll get back. Okay, another way of thinking about what can we expect from markets going forward is to look at forward-looking data like yields in bonds and real earnings yields of stocks and dividend yields of stocks and growth in dividends. And when we use these kind of market forecasted ways of getting expected return, this chart is produced by our partners at AQR Capital, and it's based on their capital market assumptions for asset classes for 2021. You could see for each of the different asset classes, I'll start with US equities, they're using an earnings yield approach. They come up with about 4% as the real expected return on US equities going forward over the next 5 to 10 years. And then if we move all the way to the right on this chart to a fully globally diversified 60-40 portfolio, which is what many clients end up in, which is what many of our clients end up in. The real return expectation is, again, somewhat modest at just a hair over 2% real. Any questions on this slide, Brad?
No, I'm not seeing any.
Okay, great. Now turning back to the value spread idea. Value spreads are at all-time high or near all-time highs in the United States, developed markets outside the United States for value. Following 2020, which we had a value crash, which is greatly responsible for the very low PEs of value stocks and the wide spreads. What has high value spreads meant for value stocks in the past? So in the recent past, we had the value spread coming from about 3 standard deviations from the mean and crashing down to -1 standard deviation from the mean during the tech bubble, right? So what did it mean for value stocks when this PE value spread came in following the tech bubble? So the 1-year return in value stocks and the 2-year return of value stocks following the tech bubble peak was 17% for value stocks, outperformance of growth, and 56% over 2 years of outperformance of growth. So this high PE spread or value spread coming in or being at an all-time high and then coming in as a result of a crash was very, very good for value investors. And then you see a similar pattern in the great financial crisis of late 2009, early 2010, is that 1-year period and then the following 2-year period was very good for value stocks relative to growth stocks. You could think about this as being somewhat of a mean reversion, right? So you have a mean expectation of the value spread that would be around 0, right? That you're not away from the average. And then when you're far away from the average, the tendency is to come back to the right, whether your value spread is very high above average, there's a tendency to come down. So the last 2 times that we had value spreads of this magnitude were in the tech bubble in 2000 and the great financial crisis of 2009. And the periods following that turned out to be very good for value stocks. So what can we expect for going forward from value? There's 4 different scenarios. We had the quick reversion in the first quarter of 2021. Value does well, really, really well compared to growth in the first quarter of 2021. But since the regime shift was so quick, that momentum suffered in that case, right? So the stocks that were doing well, which are growth stocks, are going to be in a momentum strategy. You have this quick switch to value. So momentum is going to lag even though value is doing well. A slower reversion, which is what we're kind of experiencing now, is that value strategies are starting to have more small cap stocks in them and more value stocks in them. So if value continues to do well and small caps continue to do well, we'll have value, small cap, and momentum working in our favor. And the final version here is, because I don't want to paint the picture of, value is a sure thing and these spreads have to come in and value is going to outperform growth going forward with certainty. Things could get worse before they get better, right? Things can always continue to get worse. There's an old saying, right? The market can be wrong longer than you can be liquid. So the idea that spreads could widen and even get worse than they are now, people will continue to pay more and more and more for $1 of a growth stock's earnings, and continue to not like value stocks. That's a possibility, right? It's thankfully for value investors, it's not what we've seen in the beginning of 2021. We've seen first a quick reversion, now a slow reversion that's kind of taking hold for value investors. That's my quick factor discussion. I have a lot of topics here, not a lot of time left, so I'm going to go through them really quickly and just kind of set the stage for questions, if there are questions. First, interest rates. This is a plot of the 30, 10, 5, and 1 year constant U.S. Treasury interest rate since the beginning of 2020. And if we put ourselves in 2021 here, you can see since 2021, the beginning of 2021 through the present, we've had this kind of upward increase in interest rates, except at the lower end of the curve, and then a little gradual decrease over the last month or two, right? So it wasn't a good first quarter for bonds as interest rates rose. But interest rates have come down a little bit in June and the beginning of July, and kind of softened the bad performance of bonds. In terms of corporate credit spreads, this is the spread between BBB, which is the lower end of investment grade bonds, as compared to the Treasury. You can see that the spread really spiked in March of 2020, when COVID had significant impact at the beginning of the crisis on the economy and on before any programs to help with bankruptcy risk of companies were initiated. You had this credit spread that just jumped up, which is bad for fixed income investors. But then similar to the stock market, since March of 2020, credit spreads have tightened as a result of decreased risk of bankruptcy, and credit spreads now are very, very low, around just slightly over 1% for BBBs, which is approaching all-time tightness in terms of credit spreads and low credit risk. A lot of discussion about inflation. The year-over-year inflation rate in the US, last I looked, was near 5%. Current inflation year-over-year was something like 4.8%. This is a little bit more of a longer look at inflation. The break-even inflation rate right now is just a hair under 2.5%. So the break-even inflation rate is the difference in inflation. It's the difference in yields between nominal treasuries and treasury inflected and Treasury inflation protected securities TIPS. So the difference between those two yields is a market-based inflation prediction known as break-even inflation. So what do I take from this? If we've got break-even inflation over the next 5 years at about 2.5%, and I've got a inflation rate right now of 5%, the market expects inflation to moderate, right, from its levels here, but certainly not to disappear. And why inflation? I think we're very familiar with the determinants of inflation. We have a very expansionary, accommodative monetary policy with near zero short-term interest rates, and we have a very expansionary fiscal policy with infrastructure spending on the horizon, and a lot of tax breaks and support payments being made to participants in the economy. These are leading to higher inflation expectations and inflation. High inflation countries have depreciating currencies, weakening currencies, and we see the U.S. currency depreciating over, since the beginning of the year. This is the dollar-euro exchange rate, so you can see the U.S. dollar depreciating. This is a trade-weighted U.S. dollar index, so it's not just the euro; it's all countries weighted by how we trade with them. A decrease in this index represents a decrease in the purchasing power of the dollar. So U.S. dollar depreciating, consistent with higher inflation. That does tend to help ex-U.S. returns, because when you're changing those euros back into dollars, you're getting more dollars for your euro. So it does have a little bit of a benefit of help. And then just to throw it out there in case anyone has a question is Bitcoin is in the news. It's somewhere around 30,000 today. You can see that it came off of its levels by 50% of almost 60,000 not too long ago. Very volatile as an asset class, about 5 times as volatile as equities. It's certainly a speculative asset at this point. If we don't have it in any of our portfolios, it's not that we're not considering it, but if you're going to wade into cryptocurrency, my recommendation would be to do it at a very small level and to be very, very prepared for very high volatility and the potential that it could go to zero. There are stories that are related to the ability to transact under the radar illegally, that gives Bitcoin value, and also for people in tyrannical regimes, gives them the ability to transact without the government's threat of seizing their assets or devaluing their currency, which tends to give some credence to the case that Bitcoin might have some inherent value. So I apologize for kind of going through those last slides so quickly, but I saw we were running kind of tight on time, and I wanted to leave a few minutes for questions. So thank you for your indulging my presentation, and I'll turn to Brad, see if we have any questions.
All right, thank you. We do have, and speaking of volatility in Bitcoin, at last I saw it was up to like 38, so it's jumped a bit. So a couple of questions that have come in. One regarding, maybe we'll do a stop. Yeah, let me just turn my video back on. Maybe you do the same as well. And with regard to retail investors, what's been the impact? What's been the biggest impact between the spreads between growth stocks and value stocks over the last, let's go back to the financial crisis and coming out of the financial crisis. What's been the impact to the retail investor regarding the spread between growth and value?
I think of retail investors as, I don't want to say unsophisticated, right? But that's kind of normally what you make this distinction between retail and those people who are supervised and then institutional. I think a lot of retail investors have probably gotten out of value because it's been a long, hard slog. And unless you were kind of committed to being a value investor because you understood the history of value and the research and the rationale behind value investing, I think it would probably be a rare retail investor who was able to stick it out through these ups and downs, right? So most value investing, I'll say most, many value investors have the benefit of a financial advisor, and it doesn't just help in value, it helps keeping people in the market. In March of 2020, when everyone's running for the exits with their hair on fire and a financial advisor says, slow down, right? We're in this for the long haul. Let's look at your plan. Let's look at how we've realized the returns, right? I think the same is true for value. So value investing, especially value investing right now, requires a little bit of being a contrarian. You have to look and say, wow, growth stocks are really expensive, right? And even though a lot of the wealth that's been created in the US in the last few years have been from growth stocks like Amazon and Google and Tesla and Facebook and Microsoft, that perhaps they're bid up too high. And maybe the time is to not be in that crowded trade of growth stocks and to be a contrarian and to move to value. I'd say that's probably a fairly rare value probably a fairly rare run-of-the-mill retail investor off the street. But I think smart money, I think institutional investors, I think investors who are being guided by financial advisors who understand that chasing returns is not always in your best interest, are going to be what fuels the rally if we have if the rally continues.
All right.
Hopefully nobody identifies as a retail investor there, and I didn't insult anybody. I guess we're all retail investors to some extent.
So maybe switching to the fixed income side. So with low interest rates for bonds and then possible future inflation, what are your thoughts on what might happen to real returns for bonds in the future? Maybe short term and even longer term.
Yeah, so that's bonds are a tough spot to be right now, right? The yields are low, inflation's high. If you look at TIPS yields, which are real returns, it's the market's it's what the market's offering for a real return on a 10-year treasury. They're negative. They're not just a little bit negative, they're minus 1.5% or 1.7% negative. So I'm not saying you shouldn't be in bonds. So I'll take a step back and think, bonds are an important part of everyone's portfolio. It allows you to really calibrate the risk of your portfolio. Bonds tend to have 0 to slightly negative correlation with equities. If equities were to crash real hard, you typically get a little rally in bonds, especially in treasuries where there's a flight to quality. So I tend to think of bonds as that part of your portfolio that you're not necessarily looking to for return, although it's been really good provider of return over the last 30 years, right? It's since 1980. I tend to think of it more as kind of be like your bulwark against equity risk, right? It's going to give you a coupon payment. It's going to give you low volatility, and it's going to give you low to slightly negative correlation with equities. Personally, I've started to move. I don't have a lot of money in bonds. It's just doesn't fit my risk profile. I'm a tenured professor. I have a pension from the military. I don't need bonds, right? I've got that taken care of. So I don't really have a lot in bonds. But the little I had in bonds, I started to migrate a little bit to alternatives, right? So alternatives give you the promise of, liquid alternatives give you the promise of that low correlation with different risks than bonds, right? So I feel like I'm diversifying my low correlated risk away from inflation, away from credit, because credit spreads really have nowhere to go but wider, which is not good for bond investors. So I've started to diversify that kind of fixed income portion of my portfolio into alternatives. And we have alternatives portfolios available in seasons, and you don't have to be a hedge fund investor to get an alternative exposure these days.
Yeah, good point. Alternatives are much more available to the retail space. We have time for one final question, and then we'll wrap up. This is back to a slide that you showed during the presentation, but just final thoughts on market valuations right now, or stock valuations, and where they're at, and what that potentially means for future returns looking into the future.
Yeah, so it's always tempting when you look at that. You look at that PE data, right? The Schiller PE data, to say, well, I should be out of equities, right? This doesn't look like a good place to be. But then the question is, well, where do you go, right? You need to be in equities in order to earn the market risk premium, right? You need to be in the market to get market returns. Even if the market tends to look a little expensive right now relative to its historically, I don't mean to say that equities are unattractive in your investment opportunity set that's available to you right now. I actually don't think that you should be rotating out of equities and into something else, right? Real estate, right? I would say that you have a plan, you stick to it. The way I take that PE data is, I'm not a financial planner, right? Brad is. If I was a financial planner, and the way I tell the financial planners that I work with is, you need to temper your expectations for future returns. That would be my, in terms of the planning exercise, you might be doing yourself and your clients a disservice by assuming you're going to earn 6% real, right? The data doesn't really support that, given the environment that we're in, right? So that would be that's what I take from that PE data is, yep, markets are expensive. I might need to moderate my expectations of returns going forward. It's not a strong enough signal to time markets going in and out of markets. You can miss out on a lot of return by doing that.
All right, thank you. And that kind of runs us up against the end of our time today. Thank you, Dr. McDermott, for sharing with us great information. And thank you, all of you, for attending today's session. I will just let you know, November 22nd, we will have another one of these sessions. Jeffrey Kleintop from Charles Schwab will be joining us and giving us thoughts as we approach year end and as we head into the new year. So with that, we'll conclude for today, and have a great day and a great week.